It's all covered in today's China Truths.
Beijing is spiraling out of control. China's economy is plunging off a cliff. While Beijing and Washington are still locked in economic and trade talks in London, a bombshell has dropped. China's latest economic data reveals a devastating blow: plunging consumer power, crashing product prices, and collapsing import-export figures that shattered market expectations. Panic is spreading fast. Facing a rapidly worsening crisis, Beijing scrambled to roll out new policies in a rush to address the urgent needs of the people. But doubts are mounting about whether any of it will work. As senior Chinese and American officials huddled in London during a temporary tariff war ceasefire, Beijing simultaneously released a flood of gloomy economic data. The results were far worse than analysts had anticipated, instantly drawing global attention. On Monday, June 9th, China's General Administration of Customs reported a staggering collapse. Exports to the U.S. nosedived by 34.5%, marking the steepest drop since the pandemic. Despite modest growth in exports to ASEAN and the EU, total exports in May rose only 4.8% year-on-year in USD, falling short of the 6% forecast. Even worse, May's export growth had slowed significantly from the 8.1% seen in April. Meanwhile, imports tumbled by 3.4%, a decline even deeper than expected. Other indicators painted the same grim picture. China's Consumer Price Index, CPI, posted a year-on-year decline for the fourth consecutive month, signaling persistent deflation. At the same time, the Industrial Producer Price Index, PPI, plummeted by 3.3%, the sharpest drop in nearly 2 years. The Chinese economy is now in freefall. The relentless U.S.-China trade fight is pouring fuel on the fire, accelerating the breakdown of exports. U.S.-based economist Cheng Xiaonong sounded the alarm, stating that the data, already beautified by Chinese authorities, still reflect a deeply deteriorating economy. He noted that May's exports to the U.S. were based on pre-tariff orders, making the steep drop even more alarming. The situation, he warns, will only worsen in June. Chung emphasized that although China has ignored international norms like the Geneva Agreement, it's still negotiating with the U.S. under the shadow of trade war. Yet these talks are merely superficial, as the deeper wounds fester. For China, a nation whose lifeblood is exports, the damage from capital flight is overwhelming. Chung bluntly warned, "The trade conflict between China and the U.S. will keep escalating." China, once the beating heart of global manufacturing, is now fading into the background. Foreign companies are pulling out month by month. Orders are drying up, investments are vanishing. This is not temporary. China's gradual exit from the global supply chain is irreversible. He added that the sharp drop in exports is only part of the story. Imports, an early indicator of future production, are also crashing. He explained, when imports fall, it means factories aren't buying raw materials. No raw materials means no production, no repackaging, no exports. A drop in energy imports shows idle factories and shrinking labor demand. His conclusion is chilling. From collapsing imports to crashing CPI and PPI, all signs point in one direction. China's economy is heading for a cliff-edge collapse. While China's exports to the U.S. are plunging amid the tariff war, the situation at home is even more alarming. Internal circulation is collapsing, and deflation has persisted for months, triggering growing fears about a full-blown economic meltdown. Both CPI and PPI are falling in tandem, and the internal economic engine is sputtering. China is trapped in a vicious cycle of collapsing consumer demand, with no clear exit in sight. Economist Commander warned that despite ongoing China-U.S. negotiations in London, there's still massive uncertainty. Will any deal be reached? And more importantly, will it even be enforced? Meanwhile, the hard truth is undeniable. China's CPI and PPI are both plunging. And that dual decline signals something far worse. Prices for consumers will continue to fall, not due to health or competition, but because of systemic weakness. Even if China and the U.S. somehow reach a new consensus, it won't be enough to break the downward spiral of evaporating demand caused by a breakdown in internal circulation. Commander explained. Previously, it was just the CPI dropping month after month, while PPI held up. But now PPI, China's Industrial Producer Price Index, is also in free fall. That's a red flag. When PPI drops, it means businesses are earning less. Lower profits lead to layoffs. And rising unemployment hits CPI harder because jobless people don't spend. So now that both CPI and PPI are falling, deflation is no longer a surface-level issue. It's deep-rooted, systemic, and dangerous. This is deflation starting from the supply side, and that kind of deflation cuts deeper and lasts longer. In response, Chinese ministries have rolled out a string of policies, scrapping household registration limits for workers seeking social insurance, adjusting the minimum wage mechanism, all in a bid to calm public fears and restore hope in the future economy. But Commander remains skeptical. He said the real fear among Chinese citizens is not just about current hardship, but whether the future can still be bright. These new policies? Mere gestures. Without bold, large-scale fiscal subsidies to jumpstart consumption and reignite public confidence, Beijing will not be able to truly address the anxieties and suffering of its people. What just happened? China's stock market nosedived out of nowhere. Panic swept through investors. On the afternoon of June 10th, China's stock market took a shocking plunge. Rumors spread like wildfire that trade talks between China and the U.S. had hit a wall, and the market reacted instantly. According to Bloomberg, China's market wiped out earlier gains just before day 2 of the high-stakes negotiations between the world's two largest economies, revealing deep investor anxiety over unresolved tensions. The Hong Kong-China Concept Stock Index flipped from a 0.5% gain to a 0.9% drop. The CSI 300 index, the benchmark for domestic Chinese stocks, also reversed into negative territory. Meanwhile, U.S. stock index futures slipped from their daily highs, signaling broader concern. Bloomberg noted that the exact trigger behind the sudden nosedive remained unclear. However, some investors pointed to a sharply worded commentary from CCTV's social media account. It emphasized that while China is sincere about trade negotiations, it will stand firm on principles, calling on the U.S. to remove all hostile measures and acknowledge progress made so far. Amidst the turmoil, Chinese rare earth stocks skyrocketed. Shares of China Rare Earth Holdings Limited soared 26%. Rare earths, a strategic battleground in the trade war, became a flashpoint once again. Speculation is growing that talks are going poorly. The jump in gold and rare earth stocks signals growing hedging behavior, said Fu Shifeng, investment director at Chengzhou Investment. Just hours before the dive, optimism had been rising. Traders were hopeful for a breakthrough, and the Hang Seng China Enterprises Index was marching toward a bull market. The two delegations had spent over 6 intense hours negotiating at Lancaster House near Buckingham Palace, wrapping up day 1 of the talks in London. A second round was scheduled for 10 a.m. Tuesday local time. Back in Washington, President Donald Trump told reporters, "Dealing with China? It's not easy. Shanghai can't take it anymore. A state-owned giant has reportedly halted all performance bonuses. Even the strongest is starting to crack. The CCP is facing a deepening economic crisis, and now even Shanghai, the city once hailed as having the healthiest finances, is showing serious signs of collapse. Reports say that China Railway Shanghai Engineering Bureau Group has completely stopped paying performance bonuses. Online, netizens call it what it really is, a disguised mass layoff. A notice bearing the official seal of China Railway Shanghai Engineering Bureau Group has been circulating online. The content? Brutal salary cuts. Starting June 1, 2025, the entire group and its subsidiaries will halt all performance-based salaries and bonuses. Only basic pay and minimal statutory allowances will remain. For internal retirees and idle staff with no clear division between base and performance pay, the new rule slashes their salaries to just 40% of their current standard. The notice didn't stop there. It issued a stark warning. Any unit that fails to implement these changes will face public criticism, and the responsible personnel will be held accountable. It was signed on June 6th. A photo of the notice has gone viral across Chinese social media. Some independent media claim that this is just the tip of the iceberg. The entire Chinese construction industry is facing unprecedented pressure, and this shocking move by a state-owned enterprise with Zhong, China, in its name reflects just how dire things have become. If even these giants are slashing salaries, how can others survive? Netizens are alarmed. Shanghai is the only province with a fiscal surplus, one person wrote. If even Shanghai is falling apart, the Chinese economy is finished. An insider from China Railway Shanghai Engineering Bureau confirmed the news and called it what it is, a disguised layoff. When one netizen asked, "Don't central SOEs lay off people?" the employee replied, "If your salary can't cover your mortgage, do they even need to fire you?" The employee added that despite the pay cuts, he doesn't dare quit. "Where would I go? The market is a dead end." Others echoed this sentiment, noting that salary cuts are just a stealthy way to force people out without severance. One netizen wrote, "State-owned companies with Zhong in their names have mastered the layoff game. Pay suspension, salary cuts, psychological pressure to quit. Private companies are simply copying their tactics."
Please share your thoughts in the comments section below. We will keep reporting on the COVID surge in China, so don't forget to subscribe to our channel and turn on the notification bell to get the latest videos. And thank you for tuning in.